Welcome to Financial Recovery 101. In this video, we address the real threat to your savings, inflation, and lay out a practical, step-by-step plan to move from debt to disciplined, long-term investing. We will keep things simple, actionable, and focused on building durable habits. To begin, let's outline exactly what you will learn today. Here is our roadmap. First, we will clarify why inflation is a more dangerous risk than many people realize. Next, we will tackle high-interest debt. Then we will build safety with an emergency fund. After that, we will move to automated investing in low-cost index funds and discuss what to buy and what to avoid. We will also address security and psychology so you can take action confidently. Finally, you will get an action plan and quick quizzes to check your understanding. With that in mind, let's begin with a brief but important disclaimer. Before we proceed, this video is educational and not financial, legal, or tax advice. Your situation is unique, and you should consult a licensed professional for personalized guidance. Investing carries risk, including the potential loss of principal. Past performance does not guarantee future results. Now, with expectations set, let's examine the real threat: inflation. Inflation erodes your money's purchasing power. Even when prices rise slowly, years of inflation can significantly diminish the real value of savings parked in low-yield accounts. While fear of investing is understandable, the greater, more certain risk is doing nothing and letting inflation quietly erode your hard-earned cash. With that context, let's move into the first, most urgent step to regain control. Step 1 is to eliminate high-interest consumer debt, such as credit cards and certain personal loans. The reason this comes first is mathematical. The interest on these debts often exceeds what you can reliably earn in the market. As a result, paying them down is a risk-free, guaranteed return. Target debts with annual percentage rates at or above roughly 8 to 10%. Select a payoff strategy. The avalanche method prioritizes the highest APR first for maximum interest savings. The snowball method targets the smallest balances first for faster psychological wins. Either method works. Pick the one you can stick to. Use every tool available, including negotiating lower rates, using balance transfers carefully if they truly lower costs, and reducing non-essential spending temporarily. Importantly, do not invest in the stock market while carrying high-interest consumer debt. Prioritize debt elimination. Next, once the high-interest debt is handled or under control, we build your financial safety net. This flowchart presents the overall sequence for financial recovery. We start by identifying and aggressively paying down high-interest debt. Once that is controlled or eliminated, we establish an emergency fund of 3 to 6 months, essential expenses in a high-yield savings account. Only after those conditions are met do we proceed to set up a brokerage and automate recurring contributions into low-cost index funds. A decision note confirms that you have no high-interest debt and at least a 3-month emergency fund before investing. Finally, the plan emphasizes long-term holding of 5 years or more, reinforcing that only long-term money belongs in the stock market. Now that you see the map, let's detail the emergency fund. Your emergency fund is a buffer against job loss, medical expenses, or unexpected repairs. Aim for 3 to 6 months of essential expenses, leaning towards 6 or more if your income is volatile. Keep this money in a high-yield savings account for liquidity and safety. The goal is not growth, but stability. Automate transfers on a weekly or bi-weekly schedule, ideally right after you get paid, to remove friction. Keep the fund clearly separated from your daily spending accounts to prevent accidental use. This money is your safety net, not an investment. With your safety net in place, you can confidently move to automation and investing. Let's compare account types. A high-yield savings account is a bank or credit union account generally covered by FDIC or NCUA insurance. It offers high liquidity, typically same day to a few days, and is intended for safety and emergencies, with no market risk to principal. Returns are variable but usually lower than long-term stock market returns. A brokerage account is different. It is covered by SIPC, which protects securities and cash in case the brokerage fails. But it does not protect against market losses. Liquidity is high but tied to market hours and settlement times. Brokerage accounts are for investments intended for long-term growth and will fluctuate in value. Now, let's visualize a simple budget allocation while you are in recovery mode. This pie chart illustrates a sample allocation while you are aggressively paying down high-interest debt and building your emergency fund. Roughly 50% goes to necessities, 20% to accelerated debt payments, 10% to the emergency fund until it is fully funded, 15% to investing if and only if high-interest debt is cleared and the emergency fund threshold is met, and 5% to guilt-free spending to maintain morale. These percentages are guidelines. Adjust them to your circumstances. Next, let's set up the systems to make this automatic. Automation converts intent into results. Begin by choosing a reputable brokerage you trust. Open the appropriate accounts, including a taxable brokerage and retirement accounts if you are eligible and they fit your plan. Link your bank and set automatic transfers that align with your pay schedule. Select low-cost index funds that track the broad market or the S&P 500 and schedule recurring purchases. Enable two-factor authentication and account alerts to improve security. Finally, review your contribution amounts annually and increase them when your income rises or expenses fall. Now that the system is in place, let's clarify exactly what to buy and what to avoid. Your core holdings should be broad, low-cost index funds, such as total market funds or S&P 500 funds. Examples include widely available ETFs and mutual funds like VTI, ITOT, SWTSX, or VOO, IVV, and FXAIX. Focus on expense ratios at or below roughly 10 basis points. Lower costs compound in your favor. Broad market funds provide diversification across many companies and sectors, reducing idiosyncratic risk. Avoid frequent trading, speculative stock picking, and high-fee complex products for your core portfolio. Most importantly, only invest money you will not need for at least 5 years. With the investments defined, let's anchor the 5-year rule on a timeline. This timeline reinforces the 5-year rule. Starting today, focus on clearing high-interest debt. Over months 1 through 12, build and complete your emergency fund. From year 1 to year 5, keep automatic contributions flowing into your low-cost index funds. Beyond year 5, stay the course, rebalance on a simple annual schedule if needed, and increase contributions as your income allows. The key message is that only long-term money belongs in the stock market. With that principle in mind, let's test your understanding with a quick quiz. Question: which comes first on the path to financial recovery? Options: 1. Start buying individual stocks. 2. Deposit into a high-yield savings account until 6 to 12 months are saved, then handle debt. 3. Eliminate high-interest debt, then build a 3 to 6 month emergency fund. 4. Time the market with short-term trades. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to eliminate high-interest debt first and then build a 3 to 6 month emergency fund. This sequence prevents expensive interest from working against you and provides the stability you need before moving into long-term investing. Many people hesitate to invest due to perceived security concerns. Using an established brokerage with good security practices is generally sufficient for most investors. SIPC protection covers certain losses in the event of a brokerage failure, but does not protect against market declines. Follow best practices such as enabling two-factor authentication, using strong and unique passwords, turning on account alerts, and accessing accounts over secure networks. In the long run, disciplined, consistent contributions beat attempts to time the market. Maintain a simple, automated, low-cost, and long-term approach. Now, let's map a concrete paycheck plan you can adapt. This table provides a sample paycheck allocation you can tailor. Allocate approximately 50% to necessities, 20% to accelerated high-interest debt payoff, 10% to the emergency fund until you reach 3 to 6 months of expenses, 15% to investing in low-cost index funds, and 5% to discretionary spending for sustainability. Adjust these percentages to fit your situation and shift former debt dollars to investments once the debt is gone. Next, another quick quiz to reinforce the time horizon rule. Question: which money belongs in the stock market according to this plan? Options: 1. Rent money needed next month. 2. Emergency cash set aside in a high-yield savings account. 3. Funds you will not need for at least 5 years. 4. Credit card balance transfers. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is funds you will not need for at least 5 years. Short-term needs And your emergency fund should remain in cash, preferably in a high-yield savings account. Investing is for long-term goals where you can ride out volatility. Here is a compact, Markdown-style checklist you can save or screenshot. First, eliminate high-interest debt. Second, build a 3 to 6 month emergency fund in a high-yield savings account. Third, automate transfers and recurring purchases into low-cost index funds. Fourth, commit to a long-term time horizon of 5 years or more and ignore market timing. Fifth, optimize annually by reviewing and increasing your contributions when feasible. To wrap up, let's capture the key takeaways and give you a 1-week action plan. These are the essential points. Inflation erodes cash. High-interest debt must be eliminated first. A high-yield savings emergency fund provides stability. Automate contributions into low-cost index funds. Only invest long-term money in the stock market. And above all, consistency over time beats attempts at timing. Now, let's end with a concise action plan for your first week. In your first week, audit your debts and decide on the avalanche or snowball method. Open a high-yield savings account and schedule automatic transfers. Calculate your 3 to 6 month emergency fund target. Choose a reputable brokerage and turn on two-factor authentication and alerts. Select a single, broad, low-cost index fund and schedule recurring purchases. Finally, set a calendar reminder for a 1-year review to increase contributions as your finances improve. Before we close, here's a final encouragement to stay the course and keep it simple. Thank you for watching. If this video helped, please like, share it with someone who needs a reset, and subscribe for more simple, proven money strategies. Post your questions and progress in the comments. Your story can motivate others. Keep it simple, stay consistent, and I will see you in the next one.